Should I invest in shares or should I pay down my mortgage? This is one of the incredibly common questions that we get asked and is faced by many Australian expats. So in this video, it's 2025, we're going to dive into a real life case study to work out what's going to be the best option in this particular scenario. So let's dive right in. Hi there, Jared Brown here, Australian expat financial planner here in Singapore. Today we're comparing the two scenarios of either paying down our mortgage or investing in shares. Now, of course, there is that third option, which is often a good consideration for many, and that is a combination of both. But in this video, we're going to run through the numbers, work out exactly how we work out the after-tax return of each of those options. So let's first consider property. Let's say that I've got $1 million property back in Australia. It's generating me a rental income of $40,000, $50,000 a year, so 4 to 5% gross rental yield, and I've got a mortgage on that property of $800,000. Now, current interest rates on investment loans in Australia sit at around 6%, low sixes, give or take. It's mid-February 2025, just for context. Now, let's say I've got $500,000 sitting in the bank and I'm wondering whether I should put that money into that mortgage or into shares. Well, if I put it into the mortgage, that's going to take that mortgage from $800,000 down to $300,000. What is that going to mean? Well, it's going to save me about $30,000 in interest each year that money sits in that mortgage or in the offset account. What does it actually mean, though, in terms of cash flow and my return on that $500,000? Well, if we consider that money sitting in the mortgage, let's say right now, without that money sitting in the mortgage, that property costs me about $20,000 per year. I've got council rates, water, property management, repairs, a little bit of vacancy, things can break. I've got to pay all of the holding costs of owning that property. There might be some small bank fees here and there, and that gives me that negative cash flow each and every year. Rent coming in, interest, and property expenses going out. Now, if I put that money into the mortgage and I reduce those expenses by $30,000 per year, then my $20,000 outflow goes to a $10,000 inflow. Not bad. So I'm effectively generating $30,000 of improved cash flow before we consider tax. Because now that $10,000 that's coming into my pocket gets taxed at non-resident rates, which is 30%. And no, there is no tax-free threshold for non-residents of Australia. It's 30% from $1. So I take my $500, I put it in, it gives me a small return on that cash. Yes, I have less debt, not a bad outcome. What if instead I put that into a high dividend paying portfolio of shares or just a high dividend paying ETF? We use the ETF for simple illustration in this video, not a recommendation to go out and buy this. Obviously seek advice, work out what's right for you. But let's consider the Vanguard Australian High Dividend Share ETF, VHY. Now, over the last 12 months, that delivered a grossed up dividend yield, meaning franking credits coming in, of 6.4%. So I could take my $500,000, put that into that ETF, and generate 6.4% on that money. So that's about $32,500 that comes into my pocket from that dividend yield each and every year. Obviously, there may be capital growth, those share prices can go up and down, but that is the return on my capital. So am I actually better off putting that money in property or into shares? Well, in that simple example, shares deliver a better cash-on-cash return. Then, of course, we have the added considerations of liquidity. I can sell some shares, I can't sell bricks in the wall. Not yet, maybe one day there will be more options to look at things like that. Capital gains tax. Capital gains tax on shares for Singapore residents is 0%. Capital gains tax on property, again, starts at 30% and goes all the way up to 45%. There is also no 50% discount on that property for non-residents of Australia. So these are the things that we need to think about when we look at how do we allocate our capital. There is no one size fits all, one is not better than the other, but when we are sitting on cash wondering what should we do, crunch the numbers, run the scenarios, seek advice, and work out exactly what's best for you. Thank you for tuning in. Do remember to subscribe to the channel, like the video if this has been of value. Feel free to reach out with any questions at all. I look forward to seeing you in the next one.